So hi everyone, thanks again for joining us today, and thank you Vartika for speaking. It's great to have you. So Vartika Satija is a Calgary-based independent professional accountant that provides professional services to individuals, sole proprietors, small, medium-sized businesses, and non-for-profits. Her passion is to partner up with individuals and businesses to provide ongoing guidance tailored towards their unique financial and tax requirements to help them grow and achieve their goals. Her intensive experience includes personal and corporate tax compliance, tax planning, and other business advisories who have been involved in all sorts of businesses such as manufacturing, professional services, construction, retail, restaurants, real estate, etc. Thanks again for speaking today, Vartika, and good luck with your presentation.
Can you hear me now?
Sorry. Yeah, I can hear you now. Sorry, it looked like I think you just had it muted for a second there.
Right.
All good
Okay,
now. Okay, great.
perfect. Thank you, Alex, for the introduction. I appreciate that, and I am really grateful to be presenting today to the group about business dividends versus salaries. I know this is a big question once people end up, incorporating the corporation and wanting to know what's the best way to compensate themselves from the corporation. So just to give you a little bit of a background, once an individual goes and incorporates their corporation, they have to almost change their mindset, and they have to realize that now they're an independent party from their corporation. Even though they are the business owner, and they feel like this is my business and this is what I do all day long, but still from your mindset you almost have to separate yourself as a separate individual identity. So what I mean is that your corporation becomes a separate entity. You become a separate entity. So how your corporation now pays you all depends, on whether you can take it as a salary or you take it as a dividend. And I'm going to talk a little bit about both the differences. What are the benefits of taking a salary, and what are the benefits of taking dividends? Okay, so first thing, how you should pay yourself as a business owner. So there's basically two options. The first one is whether you pay yourself as a salary, including a management bonus if you take just one-time bonus at the end of the year, or you pay yourself as a dividend from the corporation. And the answer is it all depends. So it all really depends on your circumstances and the company's financial position. So we'll talk a few things. So the first category I'm going to talk about is if corporation pays a salary, and what are the benefits of receiving a salary. So one thing you want to be careful is, when you do receive a salary from your corporation, it's a T4 income. So a lot of us who have worked for corporations, that are not our own, who are not self-employed, but we go and take employment somewhere, at the end of the year, we get a T4 slip. So similarly, if you are paying yourself a salary from the corporation, the corporation has to issue a T4 slip. So it's called a T for income. So the first benefit I would say is salaries paid will be an expense for your corporation. So it actually helps you reduce the taxable income in the corporation. So it becomes a big deciding factor if your corporation makes about 600,000, if they cross the small business limit. So you know how in Canada, if we are a small business corporation, which means that we make under 500,000, we get like a preferential rate in the corporation, which is the 9% federally. So if you want to keep that, you want to lower your taxable income, salaries are the best way to pay yourself to keep your, taxable income low, so you end up paying less taxes in the corporation. Salaries help you build RRSP contribution room. So this is one of the biggest advantage of having to pay yourself a salary if you want to contribute into the RRSP and you want to build that room, because each one of us can only contribute to the point we have built that room, which is always that 18% of the earned income from the prior year. So in order for us to build our room, we need to pay ourselves a salary. Salaries also help us contribute into the Canada Pension Plan. So basically, based on how long you contributed, it can be an important retirement consideration. So salaries, once you do pay yourself a salary, there is always an employer and an employee portion of CPP that needs to be contributed to to the services benefit under the Canada Pension Plan. So it depends, that only gets through a salary. I know, I'm talking employer versus employees. So basically, once you do get a salary from your own corporation, you become an employee of your corporation. And that's why I use the word employer versus employee portion, which means you have to contribute your portion and your corporation has to contribute their portion. And then income tax will be withheld at each payment and remitted to CRA. So, so what happens is that, you're not waiting till the end of the year to make that big tax bill to CRA. So your income taxes would have already been withheld during the year, on a monthly basis or a quarterly basis, depending on how you've set up your salary payroll system with the government. So that becomes a big consideration for a lot of people, because we don't like to see a one big lump sum bill at the end of the year. It's always nice if we can spread it out throughout the year. So salaries kind of give us that benefit. So further benefits is, this is one of the most important things, that if you are applying for mortgages, banks like to see a steady and predictable income, and that usually can be seen through a salary. This, I have got a lot of pushbacks from clients when they get themselves paid like a sporadic dividend. Banks don't like seeing that. Banks do like seeing a nice T4 income coming from your corporation. So when it comes to making decisions for mortgage, I think paying yourself a salary is definitely something you want to consider. Childcare expenses. So salary expenses can help you reduce salary income can actually help you take this deduction on your personal tax return. So if you have children and you do incur childcare expenses, having a salary will help you take that deduction on your personal taxes. Otherwise, getting a dividend does not give you that childcare expense deduction on the tax return. So something to consider if you're having children or you're going to have children in the future years. Canada Employment Tax Credit and CPP tax credit is also just available to salaried income on your personal tax. So you know how we are all entitled to certain credits on our personal taxes. So when you do take a salary income from your corporation, the Canada Employment Tax Credit and the CPP tax credit do pop up, and you do get that credit when you do apply for take a salary from your corporation. So these are some of the benefits to consider while you want to pay yourself a salary. Now we'll talk about some of the drawbacks of receiving a salary. So for CPP, as I've mentioned, you will have to bear both employer and employee portion, which can approximately be about 10.2%. They keep changing that every year, but this is what I, so far have an approximate figure. So you're actually going to limit that much cash flow from the corporation and yourself. So that becomes an important consideration. If a corporation is struggling or cash flow is an issue, you want to keep cash in the corporation. So those are just some things you need to make sure, because once you do declare yourself a salary, you will have to remit the CPP portions. Now, corporations will have to set up a payroll account and have to make sure that timely remittances are being made to the government. And if they're not made on a timely basis, they're definitely going to incur some penalties and interest. So those are some really important considerations to be made if you want to go the salary route, because you have to be up to date with all your admin of making sure those remittances are being made to the government. Salaries, of course, are sometimes taxed at a little bit of a higher rate than dividends. Just because, again, we do pay that extra 10% on CPP on the personal level and on the corporate level, as well as salaries are taxed more at your, whatever tax rate you fall under in the personal level, whether it's 15, 20, or like federally, of course, then provincially you have to add that percentage as well. So the tax rates are always a little bit higher. So let's move on to dividends. Let's see what are the benefits of receiving a dividend. Again, when you're receiving a dividend, you are receiving a T5 slip from your corporation. So you have to understand dividends always pay you that T5 slip and if to declare the amount of dividend you're taking from your corporation. Dividends are taxed at a lower rate than salary, which means you end up paying a little bit lower personal tax. However, just because of the fact that, dividends, you give you that dividend tax credit on the personal side of things. Dividends are not subject to the CPP EI premiums. Now, EI premiums only apply, of course, if you're a shareholder who owns less than 40% of the company. So, dividends are not, you don't have to remit EI, neither do you have to remit the CPP as well. However, which means that, you don't need to register for a payroll account with CRA. So no matter how much dividend you take from your corporation, CRA is not expecting any kind of remittances to be made on a timely basis. So again, no contribution to CPP. So if cash flow in the corporation is always an issue, or you have other pension plans to help you save for the future, then of course you don't have the obligation to contribute into CPP, which can be considered a little bit of a bigger savings for some of the corporations. And again, dividends do qualify for a Canada dividend tax credit on your personal taxes. So that's why you pay a little bit less personal taxes while issuing yourself a dividend, because of this dividend tax credit that we all get. And dividends do give you a flexible payment option. So let's say 1 month you want to take out 5,000 from your corporation. The other month you want to just take out 2,000 from your corporation. So, once you do take out that money, you can just automatically transfer into your personal bank account. There is no requirement to remit that to the government or remit any CRA amounts to the government. You can just take out whatever dividend you want and declare that as a lump sum amount of money on your T5 slip, and then declare that on your personal taxes. So next step is, let's look at some drawbacks of taking a dividend from the corporation. So dividends, again, do not help you build RRSP contribution room. So if that's an important retirement consideration for people, then dividends do not help you do that. Dividends do not qualify for employment tax credits, and also you cannot claim it on your personal taxes. You cannot claim childcare expense deductions if you declared yourself or as a dividend. Dividends paid out to children below age 18 can result in kiddie tax. So if you did pay out dividends to children age 18, you may be incurring this high kiddie tax on your personal taxes. And just to quickly talk about TOSI, this is a new rule that came out in 2019 to avoid income splitting. Basically the government said, people, it's a kind of a loophole when people are income splitting between themselves and a spouse or a relative who is not actively engaged on a regular, continuous, and substantial basis in the business. So if they are getting dividends paid while they're not actively involved in the corporation, then there's a higher tax that they have to pay on the dividends they receive. However, there are a lot of other tests that can be performed to see if tax on split income, which is called the TOSI, is exempt. So that's something you want to make sure you talk to an advisor. If you are income splitting, you are dividing dividends to your spouses or your relatives or somebody who's related to you for tax purposes while they're not involved in the corporation. You may want to go through those tests to see whether they do come under the exemption or they may have to pay the high tax. So that's kind of one of the biggest drawbacks of receiving a dividend as well. And then, of course, if you have had taxes payable over 3,000 in the year before, you're required to make quarterly installments to the government. So they don't want to wait till the end of the year for you to pay all that big lump sum money if you owed 3,000 in the year before. So they want you to break it down and pay the dividend installments. Some things to keep in mind while you pay yourself a dividend. Now, I just wanted to bring this table to show the comparisons. So salary, again, is a deductible expense for the corporation. So if something is a deductible expense for the corporations end up paying a less tax. It takes it as a dividend. It takes it as an operating expense, whereas dividends is not an operating expense for the corporation. So dividends are only issued based on the share percentage ownership, and they're paid out after corporate taxes have been paid. So it's basically paid out after your earnings have been made minus all the taxes that have been paid. Whereas salaries are paid before the corporate taxes have been issued out to the government. So always try to see the difference between that. T4 slip is issued by the corporation, and the deadline for that is always February 28. If you're issuing yourself a salary, if you're giving yourself a dividend, it's a T5 slip, and that also has to be paid by February 28, has to be issued by February 28. So keep those deadlines in mind, because if you don't issue those slips from your corporation, there's a straight $100 penalty for late filing. The other thing, we want to just quickly talk about the types of dividend income you can take from your corporation, and that always depends on the status of your corporation. So there's always two kinds of dividends that you can issue from your corporation. One is called the eligible dividends, and the other one is called other than eligible dividends. A lot of small business owners, corporations, they fall under the other than eligible dividends. So basically, if you're issuing eligible dividends, it's basically the corporation did pay higher tax rates. So they're probably medium-sized corporation who don't take small business deductions, and they pay higher taxes. So if they did pay higher taxes, the business owner also will have to incur higher personal taxes, and then they will also receive a higher tax credit. Whereas with other eligible dividends, which most of the small corporations do fall under, corporations, they pay lower taxes, which means the business owner then pays low personal tax and receives a smaller tax credit. Just to know, this is just a big overview difference between the kind of dividend income you can pay out. I can actually just do a presentation all about eligible versus other than eligible dividends, because it's a very intensive topic about how somebody pays the eligible dividends versus other than eligible dividends, and how they issue those dividends income out to the business owner. But here's just an overview of these two different kinds, and most small businesses, they do fall under the other than eligible dividends. Okay, so the way the dividend income is paid up, it's not just like you took out $5,000 from the corporation and then you issue $5,000 on your corporation, on your personal taxes. Dividend income is always grossed up. So talking about other than eligible dividend, so let's say, for example, you took out $200, it's grossed up to 15%. So on your personal taxes, you're going to show an income of $230. So it's always grossed up to a percentage, which is 15% for other than eligible dividends. But then on the other side, you do get a tax credit of 9.03%. So you're basically getting a credit of $20.77, which is like, $230 times the 9% credit is what you get on your personal taxes. So that's what gets reported on your personal tax. So for eligible dividends, again, as I mentioned, because you pay higher taxes in the corporation, the gross up is also high, but then your dividend tax credit that you get is also high. So for eligible dividends, we gross it up to 38%. So for example, on a $200 actual dividend, it's $276, and the dividend tax credit you get is about $41. It's about 15%, so which comes out to be about $41. So that's how you have to look at it. What goes onto your personal is always a gross up amount and the dividend tax credit you get. And so let's talk about just summarizing and seeing if one option is better than the other. So the way our legislation works basically is that they should leave actually very little difference overall in income taxes, which when I say overall, which means your personal and your corporate tax, when comparing dividends and salaries payments that are paid out at the same amount. So basically, in theory, One should not find much of an advantage taking one over the other. It really depends on the business owner's circumstances, as to what they are looking and where they are in the cash flow situation at the present, whether personally or corporately, and then make a decision which one is better than the other. So salaries, again, they reduce your corporate taxes, but as a result, the business owner will be taxed at his or her applicable personal tax rates on their personal tax return. Whereas dividends, they do not reduce corporate taxes because they're paid after tax earnings. And they basically are taxed as a preferred rate just due to the dividend tax credit that is available. So finally, let's look at some considerations that a business owner should make. Timely remittances. So if making timely payments to CRA is going to be your weakness, then wages is not the right way to go, because it's going to cost you more by paying late penalties, interest, if you're not making timely remittances to CRA. So there's more administration work required if you're paying yourself a salary. However, dividends, again, gives you more of a flexible option. You can take it out at any time you like, but then you're not really you're not really required to remit CRA remittances to the government when you take out the dividend. So if that's one of the things is your weakness, then maybe dividend could be the right route. Bank financing. If you are planning to purchase a home or need to qualify for a mortgage, then you better pay yourself as an employee, which is wages, salaries, because banks do like to see that as a steady income rather than sporadic dividend payments. Maternity and paternal leave. So if you're planning to have children soon, you can actually, as a business owner, opt to contribute into the EI, which is optional for business owners who make over 40, who own over 40,000. It's not a mandatory thing, but if you know in the future you're going to have children and you want to get EI, so then you can, but you need to pay yourself a salary, so then you can start remitting that EI to the government to be able to qualify for maternity. RRSP and CPP. So this is a very important consideration for a lot of people. So if you want to contribute into RRSP or CPP as a retirement plan, then definitely you have to go the salary route. You cannot build that room or contribute into CPP with dividends. Another thing is working income tax benefit. So a working income tax benefit is basically a small relief that is provided by, if you by the government, if you are a low income individual. So there are individuals, who make really a small salary, a small income in the corporation, and then they pay themselves a very small salary from the business. Then if they're below the threshold, they will qualify for this tax benefit. So sometimes it's advantageous to give a small salary to a business owner if their income threshold is on the personal taxes at a very low level to trigger this benefit. So sometimes, sometimes people who don't need to withdraw money from the corporation, it's still advantage to take that small salary to get this benefit on your personal taxes. Family trust. So if you have a bigger family, you need to pass along, the business funds future to the family, or you need to withdraw money in the future from the corporation to pay off for, your children's, education in the future. Having a family trust is important, and the family trust can actually distribute dividends to the family member. So making sure if you want to take dividends, you have a family and you want to design in a certain way that in the future they need to withdraw money, this family trust can come in handy, and they can actually issue dividends out of it too. So sometimes, depending on your situation, it can actually be an advantageous to pay you a dividend and a salary. So a corporation can do a mix of both. So just enough salary to cap on your RRSP contribution rooms and to cap on your CPP contributions, and then take the rest out as dividends. So there can be some tax advantage of doing a mix, But again, you have to see what works best in your situation and what circumstances and how much money you really need to live off of from the corporation. So last thing, just to conclude, again, as I mentioned, form of a compensation really depends on many factors and circumstances. So there's no one formula to, say, yeah, if I pay out a dividend, I save taxes, or if I pay out a salary, I pay taxes. It really depends on your circumstances, and it also depends on the corporation's financial position, present position. So you have to consider like a lot of other factors as well, not just tax factors. Like, what are your household requirements? What is your spouse or common law partner's personal income? Because you're jointly going to file that personally as well. And other factors as well. What are your future plans? Are children part of the plan, or trying to get a family going is trying to set up a family going is part of the plan. So a lot of those factors have to be taken into consideration to make that decision whether to pay yourself a salary or a dividend. And as I said, as a practitioner, I have seen that taking a mix of both can actually help you a little bit. But again, we have to always do the analysis to see what portion of salary needs to be paid out and what portion of dividends need to be paid out to help you maximize a little bit on your personal taxes. And that's it. I will leave the platform now for, I have about 5 minutes. If you have any questions for me, please feel free to type it in the chat. I also have a blog about this. I will actually just save this blog on the chat just in case, you missed anything out in today's presentation. You're more than welcome to refer to this blog, which does talk about exactly all that I mentioned today. About whether to pay yourself dividends or salary and what other factors to consider moving forward. But yeah, if there's any questions, I'll be more than happy to take them if you want to put it up in the chat session. Otherwise, I have posted my email address on my websites if anybody would like to reach out and ask me any questions. Alex, did you have any questions directed to you?
Hi, Vartika, can you hear me?
Yes, I can.
Okay, great. Yeah, so I just jumped on actually to help with some questions. So I don't see anything yet. Oh, wait, here we go. I see one here from John. So he asked, is it worth setting up an individual pension plan instead of maxing out RRSPs through a salary?
So individual pension plan, does he mean in setting that up in the corporation?
He doesn't clarify here, but John, if you're still watching, can you maybe just kind of clarify your question a little bit more? And Vartika, if you want to look at it as well, so do you see under the Q&A section there on the right-hand side? That's where his question is.
Okay. Worth setting up an individual pension plan instead of maxing out RRSP through a salary. Now, that is something you may want to double check with an advisor, of course, right? What is the pension plan providing? How much growth is the pension plan giving in comparison to an RRSP? I think that's something, yeah, of course, you want to double check and do your analysis. That's a complete different realm out of my expertise, of course, because it's investment advisors who can say, are my individual pension plan going to be giving me more growth when I actually need the money, or is it my RRSP going to be giving me more growth when I need the money? The only one thing I can say about RRSPs is that RRSPs is more of a tax deferral strategy. So if you do contribute today into RRSP, you do get a tax break. But yes, in the future, when you do take money out from the corporation, RRSPs will be taxed at whatever income, personal tax bracket you fall under. So it can go either way. I would say it's something you want to have a conversation with an advisor to see which of those plans will give you an advantage.
Awesome, great. Well, thanks for
I hope that answered the question. Yeah.
Yeah, so it was just the one question from John there, and I know you put in your link to the blog there, and I think you as well had your contact info up on the slides too, right?
Yeah, it's right.
Do you maybe want to just throw those in chat here? I know we have just about a minute or so left.
Sure, I'll put my email address.
Great.
Oops.
While she's typing, I just want to say, thanks for attending today, everyone. So we do have our main stage panel starting actually just about right now. So that's on the main stage there on the left-hand side. But I wanted to say just thanks for your presentation. It was really great, lots of great information, and definitely we're glad to have you today. There is a recording of the presentation available, so if you'd like a copy, just let me know and I can send it to you. And if anyone watching as well would like a copy, either get in touch with myself or Vartika, and we can certainly provide that to you.
Perfect. Thank you so much. I appreciate the opportunity, and I hope it was helpful to the audience who were attending today.
Yeah, it was great. Thanks again.
Thank you. Take care. Bye-bye.
Bye.